What's up, Metaverse and crypto enthusiasts? Welcome back to MetaVerse Update, your #1 source for everything digital. Get ready, because today we're kicking things off with a massive look at the crypto market. We've got breaking news on the massive movements of crypto whales and what it means for your investments. Stay tuned. Next up, we're tackling the biggest hurdle in crypto adoption. You won't believe how many people are failing to even buy crypto in the first place. We'll break down why the user experience is failing and what the biggest players are doing to fix it. This is crucial for anyone looking to get into the space. But wait, there's more. We're also seeing major traditional companies making big plays in the crypto world. Get the scoop on how International Business Settlement Holdings Limited is expanding its empire into the lucrative world of Bitcoin mining. Is this the next big boom for legacy companies? And finally, we're pitting two crypto contenders against each other, XRP and World Liberty Financial. Which one has the real potential to make you a millionaire? We'll break down their strategies, their backing, and what it all means for your portfolio. Stick around for all the details and make sure you subscribe and hit that notification bell. The crypto whale stampede is here. Ever feel like the crypto market is being pushed around by invisible forces? Well, it turns out those forces are massive traders, often called whales, and their moves are shaking the entire digital asset world. These aren't just random trades, they're calculated maneuvers that set the tone and emotion for the entire crypto community. Understanding what these giants are doing is key to navigating the volatile waters of cryptocurrency. We're seeing some jaw-dropping activity. One whale just dumped a staggering 408,557 UNI tokens, worth about $3.93 million, straight into Binance. This looks like a move to cut losses after some earlier setbacks. But on the flip side, new wallets are pulling out a massive 101,824 SOL, valued at a cool $22.5 million. This shows that despite a shaky market, the interest in Solana remains incredibly strong. These aren't just small transactions, they're major signals that investors need to pay attention to. They can completely change the game in the coming weeks. The strategies and feelings of these top players reveal a much deeper story about how the cryptocurrency market really works. For instance, a whale known as 0x4DC3 just made a killing, depositing 1.55 million WLD into FalconX and pocketing a huge $4.3 million profit. That's some serious market savvy. And it's not just about profits, it's about smart risk management. We're all seeing whales dive into leverage trading. One bold player put 5 million USDC into the hyperliquid platform with a 3x leverage on hype, holding long positions in ETH and Pump. This shows a calculated approach to risk that seasoned traders understand. Ethereum is also a hotspot for whale attention, with big buys of MKR tokens signaling growing institutional interest. As the heart of decentralized finance, Ethereum's role in whale strategies is becoming more important than ever. Big wallets are getting involved, sparking a lot of excitement about Ethereum's future. Even Bitcoin whales are making moves. One recently transferred a massive 2,360 BTC, worth around $260.75 million, to a new address. But this wasn't a panic sell. It was a defensive move, showing stability rather than an immediate sell-off. These large transactions can cause anxiety for smaller investors, but the overall market sentiment is a complex mix of stability and volatility. Ultimately, the resurgence of these crypto whales shows calculated navigation through a challenging and opportunity-filled landscape. Their ability to predict market shifts, adapt their leverage, and position themselves strategically is a masterclass in modern investing. For smaller investors, keeping an eye on these massive movements can provide a significant edge in understanding where the market is headed. Don't go anywhere, because the story about crypto's hidden barriers is even more mind-blowing. Next, we're uncovering why buying crypto is failing half the time, and what familiar apps are doing to fix it. The invisible wall, why buying crypto fails 50% of the time. Did you know that half of all attempts to buy cryptocurrency just fail? It's not because of market crashes or tech issues. It's because getting past the front door is a nightmare. Research shows that global fiat-to-crypto transactions fail 50% of the time, and in some places, it's a shocking 90% abandonment rate. We've spent a decade building fancy wallets and exchanges, yet the simplest step, actually buying crypto, has become harder than ever. Traditional finance is still fighting back. Banks like Nationwide block crypto purchases, and Visa is adding extra tracking codes for crypto transactions, meaning more scrutiny. Meanwhile, easy pay-by-bank systems work almost flawlessly, clearing at 99% success rates, while card purchases for crypto struggle to hit 92%. The problem is that most big crypto exchanges are built like trading floors, designed for professional investors. They're not built for someone who just wants to buy digital dollars. Regulators have even flagged some platforms for letting users borrow up to 125 times their investment, showing they're geared more towards speculation than everyday use. The recent market rally proved this. Regular retail traders were barely there. It was institutional investors and ETFs driving the buying. But the real success stories aren't coming from crypto exchanges at all. They're from fintech platforms where crypto is just another feature. Revolut hit over 50 million customers, partly thanks to crypto trading. Cash App booked $2.73 billion in Bitcoin revenue in Q1 2024 alone. Brazil's Nubank added 1 million crypto users in its first month. Today, many first-time buyers use apps they already trust, like USDC through familiar platforms, with no new apps or special knowledge needed. Even payment giants are on board. PayPal launched checkout with crypto, and Stripe made it simple to accept USDC, settling in dollars with just a small fee. For merchants, it's seamless. Crypto is just another payment option. So, where does that 50% failure rate come from? Mostly during onboarding. Users abandon the process because of lengthy Know Your Customer, KYC, checks, requiring passport uploads, proof of address, and video selfies. For someone just trying to buy $20 of crypto, it feels completely over the top. Fintech solved this by using existing KYC from traditional bank accounts. Cash App, Revolut, and Nubank didn't need new forms because users were already verified. By removing duplicate verification, they slashed abandonment rates. The lesson is clear: remove friction and adoption skyrockets. Make KYC invisible and people start buying. The real growth engine for crypto isn't policy or speculation. It's utility delivered through familiar interfaces. When onboarding, payments, and trust are already sorted, adding crypto becomes just another button. Consumers don't need to understand blockchain to want cheaper remittances or a stable digital currency. Just like you don't think about card networks when you tap to pay, you shouldn't have to think about blockchains when you move money. Companies like Stripe and Plaid handle trillions without users ever seeing their interfaces. Crypto needs that same invisible infrastructure. Companies like Paybis are building white label on-off ramps that integrate seamlessly into existing apps, offering simplified KYC and instant fiat-to-crypto conversions. Imagine a Brazilian app letting you send USDC remittances or a European neobank offering Bitcoin savings, all built into systems you already trust. The future of crypto isn't a flashier exchange. It's infrastructure so seamless, you never notice it's there until it's everywhere. And speaking of big companies entering the crypto space, get ready for a surprising mining operation. Next, we reveal how a traditional holding company is diving headfirst into Bitcoin mining. Legacy Holdings goes all in on Bitcoin mining. In a move that signals the growing mainstream acceptance of digital assets, International Business Settlement Holdings Limited is making a significant expansion into the cryptocurrency mining space. This Hong Kong-based fintech firm has announced the formation of a joint venture, specifically to dive into Bitcoin mining operations. This strategic pivot aligns perfectly with the Hong Kong government's supportive policies for the fintech industry and the burgeoning digital asset ecosystem. The company plans to acquire state-of-the-art supercomputing servers from a top global supplier and will be managed by a team of seasoned experts in the field. This venture is not just about jumping on a trend. It's a calculated move to capitalize on the evolving financial technology landscape. International Business Settlement Holdings Limited is already known for its involvement in various fintech-related services and infrastructure projects, focusing on the cryptocurrency and digital asset sectors. With an average trading volume of nearly 50 million shares and a positive technical sentiment signal, the company is showing signs of robust market activity. Its current market capitalization stands at $8.33 billion, indicating a substantial presence in the market. The market seems to be reacting positively, with the latest analyst rating for the stock being a hold and a price target of $0.50, suggesting a stable outlook. This expansion into Bitcoin mining could be a game changer for the company, potentially unlocking new revenue streams and solidifying its position in the digital economy. But is mining the only way traditional finance is interacting with crypto? Next, we're putting two very different coins, XRP and World Liberty Financial, head-to-head to see which one might actually make you rich. XRP versus World Liberty Financial. Who's the real millionaire maker? Every investor dreams of finding that one crypto gem that can skyrocket their portfolio. While hype abounds, true wealth building in crypto usually comes from assets with a clear path to long-term, large-scale adoption driven by their core utility. Today, we're putting two very different contenders under the microscope: XRP and World Liberty Financial. XRP, the token powering Ripple's payment network, is steadily expanding its use cases for financial institutions. Ripple's products are pushing XRP toward becoming indispensable for cross-border value movement and blockchain-based asset settlement. The XRP ledger, XRPL, is adding features that reduce compliance friction for institutions, making it more attractive than alternatives like Ethereum for smart contract functionality. Features like authorized trust lines and on-chain identity credentials allow issuers to control who can hold their tokens and embed KYC directly on the ledger, crucial for institutional adoption. With potential spot XRP exchange-traded funds, ETFs, on the horizon, regulatory approval could unlock access to significant retirement and traditional capital, potentially catalyzing upward price movement. While XRP's market cap is substantial, meaning it might not be a moonshot from here, steady accumulation, protocol improvements, and key catalysts could still lead to significant long-term wealth creation for patient investors. On the other hand, World Liberty Financial, WLFI, is a different story. It's a cryptocurrency business associated with the Trump family. Its flagship product is USD1, a stablecoin backed by fiat currency. The business aims to earn interest on reserves and fees from minting and network services. However, USD1 doesn't appear to offer significant advantages over existing stablecoins, making widespread adoption unlikely. Furthermore, the WLFI token's sole utility is governance, with no economic rights for token holders. Any fee-based revenue accrues to the venture, not outside holders. A significant portion of WLFI's governance token supply is held by insiders, the Trump family, their associates, and related business entities. Only about 20% of the total supply has been sold to the public or earmarked for future sales. This means that even with substantial investment, outside holders will likely never have enough sway to decide governance issues contrary to the owner's wishes. Without profit rights, a strong demand generator beyond hype or real governance power, World Liberty Financial largely functions as a meme coin. For long-term wealth building, XRP is the unambiguous winner. Its upside is tied to expanding real-world use, improving compliance features, and mainstream distribution. WLFI, conversely, appears designed to benefit its insiders rather than outside investors, potentially making most WLFI investors poorer. That's all the news for today, but we've got a rapid-fire recap coming up. Stick around to catch the highlights of today's biggest stories before you go. And that's a wrap on today's MetaVerse update. We saw crypto whales making massive market-moving trades, learned how Fintech is secretly making crypto adoption easier by fixing the 50% failure rate in buying crypto, discovered international business settlement holdings, limited diving into the Bitcoin mining frontier, and compared XRP and World Liberty Financial to see which has true millionaire-making potential. Which story was your favorite? Let us know in the comments below. Don't forget to smash that like button, subscribe to MetaVerse Update for more cutting-edge news, and ring that notification bell so you never miss an update. Follow us on all our socials to stay connected. We'll see you in the next one.